Let's actually take an example of a liability. All right. Let's actually see how deferred tax is calculated with respect to a liability. Let's look at example number 12. Current liabilities include accrued expenses. All right. We're saying that the current liabilities include accrued expenses with a carrying amount of rupees 100. The related expense will be deducted for tax purposes on a cash basis. I'm adding some additional information for us to actually understand the implication of deferred tax. The additional information is, let us say the sales is actually equal to rupees 1000. All right. Sales is equal to rupees 1000 in year one and in year two. Why did I add this information? I'll tell you as we progress, but I am giving you this additional information that sales is equal to 1000 in year one and in year two. And I'm assuming that this expense, which is actually outstanding as at year one, all right, because it's outstanding in current liabilities, it means that it was not paid in year one. I am actually assuming that it is paid in year two. Now let's actually start solving. Assume that we actually don't have the concept of deferred tax. All right. For a second, let us actually assume that we do not have the concept of deferred tax. If we quickly start plotting the journal entries like how we did in the first example, in year one, I would have sales of 1000. I'm not plotting the journal entry for that. I have also recorded an accrual of expenses. I have accrued expenses of rupees 100. The journal entry for that would be expenses debit of rupees 100 and credit expense payable or to accrued expenses of 100 rupees. All right, so I debit expenses of 100 and I credit accrued expenses of rupees 100. This is the journal entry that I have in year one. Now in year two, I'm actually paying these accrued expenses. In year two, I'm actually paying these accrued expenses. All right, so in year two, the journal entry would be accrued expenses debit of 100 and to bank of 100 rupees. Now this is the journal entry for year 2. If I start plotting the P&L, let's say if I start plotting the P&L for both the years, for year 1 and in year 2, I would have the P&L as under. So let us say this is year 1 and I have year 2. The sales for year one is rupees 1000. I have a sales of rupees 1000 in year one, and the sales in year two is also equal to rupees 1000. All right, I have sales of 1000 and 1000 in both the years, year one and in year two. Let us say I'm reducing expenses. I'm reducing expenses. The question mentioned that I have actually accrued for the expenses of 100 in year one itself. I've accrued for expenses of 100 in year one itself. So I am actually reducing expenses. I'm denoting expenses as a negative number. All right. Revenue is being denoted as a positive number and expenses are being denoted as a negative number. Let us say in year two, I do not have any further expenses. In year two, I'm not actually incurring any expenditure. If I plot the profit before tax, if I plot the profit before tax for the first year is going to be 900 and for the second year, it's going to be equal to 1000. All right. So for the first year, I have a profit before tax of 900, and for the second year, I have a profit before tax of 1000. But when I have current tax expense, if I plot down the current tax expense, now, if you think of it, this 100 rupees of expense, this 100 rupees of expense is not going to be allowed as a deduction in year one because the question mentioned that 100 rupees will be allowed as a deduction on payment, and payment has actually happened in year two. In year one, although in books of accounts I have accrued for 100 rupees of expenses, the payment has happened only in year two, and therefore, for tax purposes, deduction will be available only in year two. Therefore, in the first year, I actually have to pay tax not on 900. I should not be paying tax on 900, but I would be required to pay a tax on 1000 rupees. I'm not going to get a deduction of 100 in the first year. I'm not going to get a deduction of 100 in the first year. Therefore, I have to actually pay tax on the 1000 rupees. And therefore, my current tax expense for the first year, assuming a tax rate of 30 percentage, would actually be 300. My current tax expense would actually be 300. All right. Reason being, I'm going to pay a tax on 1000 because the 100 is not going to be allowed as a deduction on an accrual basis, but is going to be allowed as a deduction only on cash basis. My profit after tax is going to be equal to 900 less 300, which is equal to 600. Now, for year two, if you think of it, for year two, although in my books of accounts I have a profit of 1,000, in my books of accounts I have recorded a profit of 1,000. For tax purposes, my taxable income will actually be 900. Why is it going to be 900? Reason being, the 100 rupees that I actually recorded as an expense in year one is deductible in year two. So my taxable income is actually going to be equal to 900. My taxable income will actually be 900, and on 900 I am required to pay a tax of 30 percentage, and that will be 270. All right, I'm repeating myself. In the books of accounts I have a profit of 1,000, but my taxable income is going to be 900 because the 100 rupees is now going to be allowed as a deduction in year 2 when I'm actually paying the expense. When the expense is paid off, that's going to be allowed as a deduction, although it is not an expense for year 2 in the books of accounts. In year 2 I do not have any expense, but the 100 expense of year 1 is going to be allowed as a deduction in year 2, and therefore my taxable income will be 900, on which I pay a 30% tax, which is equal to 270. So 1,000 less 270, my profit after tax is going to be equal to 730. All right, so my profit after tax for year 2 is going to be 730. Now, if you think of it, over here also, we have the violation of matching concept principle. Why do we have the violation of matching concept principle? If you think of it, I recorded an expense of 100 in year 1. I recorded an expense of 100 in year 1, but the associated tax benefit, the benefit associated with this 100 expense is actually recorded in year 2. All right, the benefit that is associated with this expense of 100. All right, whenever you have an expense, that is going to be allowed as a deduction, and therefore it reduces your taxes, right? Every expense reduces your tax amount. All right, whenever you incur an expense, it reduces the tax amount. Over here we recorded the expense in accounting books in year 1. We recorded the expense in accounting books in year 1, but the associated tax benefit was recorded in year 2. All right, we saw that the tax expense actually reduced in year 2 and did not reduce in year 1. All right, so here also there is a violation of matching concept principle. All right, just like how we saw that the matching concept principle was violated in the context of income, over here also there is a violation of matching concept principle. You may not be able to look at it straightforward, but if you obviously think of it, if you notice the 300 expense of that we recorded, the 300 current tax expense that we recorded in year 1 is basically on this 1,000 rupees. This 300 is basically without deducting the 100 of expenses. The 300 is calculated as 30 percentage of sales. The associated benefit of this 100 rupees, the associated tax benefit of this 100 rupees is captured actually in year 2, where my expense actually reduced. My tax expense actually reduced in year 2. Therefore, there is a violation of matching concept principle here as well. Now, so as to ensure that matching concept is not violated, we record deferred taxes. All right, we record deferred taxes. Now, how do we record a deferred tax over here? The journal entry is going to be, if you think of it, my tax expense should ideally reduce. All right, my tax expense over here should ideally reduce because the tax benefit as a result of this expense should actually be recorded in year 1 itself. Whatever tax benefit I'm going to actually have on account of this expense should be recorded in year 1 itself, which means that I need to actually reduce my tax expense. Reduction of tax expense basically means I need to credit P&L, right? I need to credit P&L. So my credit will go to deferred tax benefit. I'm going to credit deferred tax benefit, and the debit will go to deferred tax asset. All right. So the benefit will go to the debit will go to deferred tax asset debit. The amount will be 100 multiplied by 30 percentage, which is equal to 30 rupees. And the credit will go to deferred tax benefit of 30 rupees. All right. So I am debiting deferred tax asset and I'm crediting deferred tax benefit of 30 rupees. I'm repeating myself why we are debiting DTA and why we are crediting deferred tax benefit. The reason we credited deferred tax benefit is because my expense currently in the P&L is overstated. My expense in the P&L is currently overstated. I want to actually bring it down. I would like to reduce the expense. Why do I want to reduce the tax expense? The reason I want to reduce the tax expense is because the associated benefit should actually be recorded in the current year itself. Therefore, I need to reduce my tax expense. Reduction of tax expense means I need to actually credit P&L. Therefore, I have credited a P&L item called deferred tax benefit. This is basically a P&L item. I have credited something called as deferred tax benefit. The reason why I debited deferred tax asset is because I am going to get the benefit on this 100, the tax benefit on this 100. I'm going to receive it in future. I'm going to get that benefit in future. Therefore, it is an asset for me. All right, this 100 rupees will be deductible in future. So it is going to reduce my taxes in future. Therefore, I record an asset, which means that I'm going to get some benefit as a result of this expense in future. Therefore, I debit deferred tax asset. All right. Whenever you have to pay taxes in future, you recognize a deferred tax liability. Whenever there's going to be a reduction in taxes in future, you record a deferred tax asset. All right. So whenever you actually have to pay taxes in future, you record a deferred tax liability. Whenever you're going to receive a benefit in future, you're actually going to record a deferred tax asset. That benefit could be in the form of paying lower taxes. All right. The benefit is basically over here in the form of paying lower taxes. Why am I saying the benefit is in the form of paying lower taxes? Because the 100 will be allowed as a deduction next year, and therefore you can actually reduce your taxes in future. And that is the reason we are recording a deferred tax asset and a corresponding credit in deferred tax benefit, which is a P&L item. These are the journal entries that are recorded in year one. The journal entries are recorded in year one. Now in year two, once the expense is actually allowed as a deduction, once the expense is actually allowed as a deduction, upon payment, the expense will actually be allowed as a deduction. Therefore, the journal entry we recorded in year one will actually be reversed out. We are going to reverse out the journal entry that we have recorded in year one by debiting deferred tax expense. I debit deferred tax expense. Basically, when it is a debit, it's referred to as a deferred tax expense. When it is a credit, it is referred to as deferred tax benefit. All right. So here I'm debiting deferred tax expense, which is a P&L item, and I correspondingly credit deferred tax asset of the same amount of 30 rupees. The reason why I'm now crediting deferred tax asset is because that benefit has actually been realized. All right. Once I pay 100 rupees in year two, I'm going to actually get the benefit already. I'm going to get the benefit in the form of lower taxes. Therefore, the asset should no longer appear in the balance sheet. As at the end of year two, I no longer should report the DTA on the balance sheet because I've already realized the benefit by paying lower taxes in year two. And therefore, we are reversing out the deferred tax asset that we created in year one. All right. Once we realize the benefit, the asset should no longer appear on the balance sheet, and therefore we are reversing out the deferred tax asset. All right. So these are the journal entries we'll record in year one and in year two. Let us plot the P&L incorporating the deferred tax impact. Let us plot the P&L incorporating the deferred tax impact. So I have got year one and year two. I am recording sales of 1000 in year one and 1000 in year two. I then have expenses of 100 in year one and 0 in year two, which leaves me with a profit before tax of 900 in year one and 1000 in year two. And then I have current tax expense. I'm writing it as CT. Current tax expense was basically equal to taxable income multiplied by 30 percentage. Taxable income multiplied by 30 percentage. What is the taxable income for year one? Taxable income for year one is going to be 1000 rupees because the 900 was not paid. Current tax is going to be 1000 multiplied by 30 percentage. I'm just writing how we arrived at this number. It's going to be 1000 multiplied by 30 percentage, which is going to be 300. And in year two, it will be 900 multiplied by 30 percentage. Reason being, 1000 is my income for year two. The 100 expense of year one is going to be allowed as a deduction on payment basis. Therefore, my taxable income is going to be only 900, and that is going to be 270. And then In addition to current tax, I also have deferred tax. I also have deferred tax. In the first year, the deferred tax is actually a benefit. I have credited my P&L, which means it's increasing my P&L. So I'm going to note it down in positive. I'm going to note it down as a positive number of 30. And in year two, I have an expense of 30. In year two, I have an expense of 30. So I'm actually noting it in brackets. All right. So that leaves me with a profit after tax. That leaves me with a profit after tax of 900 less 300, which is 600. 600 plus 30 is 630. All right. In year two, it leaves me with a profit of 700. All right. So this is going to be the P&L after incorporating deferred tax. Now, if you carefully look at it, if you look at it, the net tax expense for year one is actually equal to 270. The net tax expense for year one is actually equal to 270. That 270 is nothing but the book profit before tax multiplied by 30 percentage. The total tax expense, which is current tax plus deferred tax, the total tax expense, which is current tax plus deferred tax, is going to be equal to book profit multiplied by 30 percentage, or profit before tax multiplied by 30 percentage. All right. So that is the relationship between the book profit and total tax expense. Same way for year two also, the total tax expense is actually 270 plus 30, which is equal to 300. All right. That 300 is nothing but profit before tax of 1000 multiplied by 30 percentage. All right. So once you incorporate deferred tax, what is happening is the total tax expense is going to be equal to the book profit multiplied by tax rate. Book profit or profit before tax multiplied by tax rate. Without incorporating deferred tax, that is not going to hold true. Without incorporating deferred tax, the tax expense in your P&L will not be equal to profit before tax multiplied by 30 percentage. Whereas once you incorporate deferred tax, your book profit multiplied by 30 percentage will be equal to your total tax expense. So in the previous example, we actually saw, when the example 7 that we were doing, we saw how a deferred tax is calculated on an income or on an asset. All right. We saw it in the context of an income slash an asset, because interest receivable was actually an income and an asset for us. Over here, we have actually seen how to calculate deferred tax on a expense item. All right. This is basically an expense item. Now, obviously, in DS 12, just like how we had the 5 steps approach for interest receivable, we're going to also have the same 5 steps approach for expense payable as well. For accrued expenses as well, we are going to actually follow the 5 steps to calculate the deferred tax in accordance with NDS 12. All right, I have calculated the deferred tax using the shortcut approach over here by straight away taking the expense amount multiplied by 30 percentage. But we are actually going to follow the 5 steps approach that we learned under the interest receivable example over here as well. But before we do that, we have to actually now plot the tax balance sheet. We have to actually plot the tax balance sheet, which means I actually need to presume hypothetically that we are maintaining tax books of accounts. If we are maintaining tax books of accounts, I'll have to actually think of what the journal entries are in the tax books of accounts. After that, we will actually look at what the tax balance sheet is as well. All right, now before we do that, let's actually start plotting the accounting balance sheet. All right, let's quickly plot the accounting balance sheet first. Let's start with plotting the accounting balance sheet first. I'm not plotting the full balance sheet, but I'm only plotting the relevant section, since in year one, all right, we'll have 2 years ideally. In year one, I am going to actually have accrued expenses. I'm going to actually have accrued expenses of 100 rupees being reported on the balance sheet. I'm going to have 100 rupees of expenses being reported on the balance sheet. In year two, this 100 rupees has actually been paid off. Therefore, my liability will become zero as at end of year two. At the end of year one, I'm going to have 100 rupees of expenses. At the end of year two, because it is paid, my liability goes down to zero. This is my accounting balance sheet. Now let's move on to preparation of tax balance sheet. But before we prepare the tax balance sheet, let us actually think of what the journal entry will be in the tax books of accounts. What would the journal entries be in the tax books of accounts? All right. So we are actually now going to look at the tax books of accounts. All right. Now this expense is actually deductible on a payment basis. This expense is actually deductible on a payment basis, and it's not going to be allowed as a deduction on an accrual basis. Therefore, will I record this expense on an accrual basis in tax books of accounts? The answer is no. All right, whenever the tax laws permit the deduction of this expense, I will record the expense only at that point in time. All right, tax books of accounts are not prepared on an accrual basis of accounting. It's prepared based on how income tax laws recognize the transaction. Tax books of accounts are prepared based on how income tax laws actually recognize the transaction. For income tax law, this transaction is actually recognized only on payment basis. Therefore, there will be no entry on accrual. There will be no entry on accrual in year one. In year two, upon payment, the expense will actually be recognized in tax books of accounts. So the journal entry for that will be expense debit of 100. In year two, it will be the expense debit of 100 to bank of 100. All right, so I am recognizing the expense in year two, which is when the income tax laws actually recognize the transaction. All right. The income tax law permits a deduction for this expense only on payment basis. Therefore, the Income Tax Act is disregarding this transaction on an accrual basis. The Income Tax Act is disregarding this transaction on an accrual basis, and hence in tax books of accounts, we are not going to record a journal entry on an accrual basis. We are going to record a journal entry only on payment basis because the income tax laws recognize this transaction only on a payment basis. All right, so these are the journal entries in the tax books of accounts. So let's quickly actually populate the tax balance sheet. Let's quickly populate the tax balance sheet. I am going to have year one and year two. I am plotting the liability accrued expenses. Do I have any accrued expenses on my tax balance sheet as at year one? Do I have any accrued expenses? Will there be any accrued expenses that will be outstanding on my tax balance sheet as at year one? The answer is no, because I did not record any journal entry itself. Therefore, my tax balance sheet will actually have a zero value against accrued expenses. All right, I did not recognize this expense on an accrual basis. Therefore, my tax balance sheet will actually have a zero outstanding liability. In the second year also, it's going to be zero because in the second year, when I actually paid, the journal entry was directly expense account debit to bank account. The journal entry was directly expense account debit to bank account. There is no impact to accrued expenses. Therefore, at the end of second year also, my accrued expenses is actually going to be equal to zero as per my tax balance sheet. All right, now let's start the 5 steps approach that we actually have under NDS 12. All right, so the first step is, if you recall, the first step is plot the carrying amount of accrued expenses. What is the carrying amount of accrued expenses? When we are saying carrying amount, we actually have to look at the accounting balance sheet. Look at the accounting balance sheet to calculate the carrying amount of accrued expenses. As at the end of year one, all these calculations are at the end of year one. At the end of year one, accrued expenses had a value of rupees 100. Accrued expenses had a carrying amount of rupees 100 as per accounting balance sheet. All right, the second step was plot the tax base of accrued expenses. Plot the tax base of accrued expenses. When we have to plot the tax base of accrued expenses, tax base, we have to actually look at the tax balance sheet. We actually have to look at the tax balance sheet now, and the tax base of accrued expenses at the end of year one is actually equal to zero. Accrued expenses did not have any value on my tax balance sheet at the end of year one. It had a value only in the accounting balance sheet. It did not have any value on tax balance sheet. So therefore, this is going to be equal to zero. All right, this is going to be equal to zero. Therefore, the temporary difference over here, the temporary difference, which is basically carrying amount less tax base, carrying amount less tax base is going to be equal to rupees 100. All right, so I have a carrying amount of 100, I have a tax base of 0. Therefore, the temporary difference of 100 is actually equal to is also equal to rupees 100. All right, temporary difference is nothing but carrying amount minus tax base, which is also going to be equal to 100. Now, what I said in example number two is if the temporary difference is positive, it basically means that I'm going to have future taxable profit. It is the amount on which I need to pay taxes in future. I gave you the interpretation of temporary difference over there as if it is positive, it represents the amount that will be taxed in future. That was for an asset. Remember, over there we had interest receivable, but over here we have accrued expenses, and accrued expenses is a liability. All right, accrued expenses is a liability, it's not an asset. In the previous example, we had interest receivable of an asset, whereas over here, accrued expenses is a liability. So the interpretation gets flipped. The interpretation is going to get flipped. What it means is a positive over here represents amount that will be allowed as a deduction in future. All right, over there positive was amount that will be taxed in future, and negative was an amount that will be allowed as a deduction in future. Positive was where the amount will be taxed in future in case of an asset, and negative was that where it will be allowed as a deduction in future. In case of liabilities, the logic is actually flipped. All right, positive represents amount that will be allowed as a deduction in future, amount that will be allowed as a deduction in future. And negative represents amount that will be taxed in future, amount that will be taxed in future. Now, obviously, you might get confused as to why positive in asset represents one thing and positive in liability represents something else. All of that we're going to discuss the logic in the subsequent lecture. Exactly in the subsequent lecture, we'll discuss why we are actually interpreting it this way. All right, I'll actually give you the logical reasoning of why positive represents amounts that will be taxed in future in case of asset, and why it represents amount that will be deducted in future in case of liabilities. The logic is something that I will actually explain as we proceed through the lectures. All right, but for now, what I want you to remember is a temporary difference of positive in case of liability represents the amount that will be allowed as a deduction in future. Now, so this is actually going to be regarded, this 100 rupees is going to be regarded as a deductible temporary difference. The 100 rupees will actually be regarded as a deductible temporary difference. Why is it a deductible temporary difference? Because it is a positive amount. It basically means I will be allowed a deduction of rupees 100 in future, and therefore this is going to be regarded as a deductible temporary difference. All right, since I'm going to get a deduction of 100 in future, that will be classified as a deductible temporary difference. And on this, I will be calculating deferred tax asset. I am going to calculate deferred tax asset. Why is it an asset? Because since I'm going to get a deduction in future, that is basically a benefit to me. On that, I am basically recording a deferred tax asset. On this, I'm recording a deferred tax asset because it's a benefit that's going to come to me. Therefore, I'm recognizing an asset. All right, so how much will be the value of the asset? It will be deductible temporary difference multiplied by the tax rate, which is equal to rupees 30. All right, so we have a deferred tax asset of rupees 30. The fifth point is irrelevant in case of year one. The fifth point is irrelevant in case of year one, which is change in DTA is equal to rupees 30 itself. All right, because this is the first year of operation, whatever is the amount of DTA, that entire amount basically represents the amount that needs to be recognized in the current year. There is no previous outstanding DTA. So therefore, the journal entry is going to be DTA, deferred tax asset debit, and credit deferred tax benefit. All right, I'm going to credit deferred tax benefit. All right, now obviously the answer is going to be the same as what we already saw, right? We already knew that the answer was going to be 30 percentage, just that this is the format in which Ind AS 12 requires us to recognize. This is the format in which Ind AS 12 requires us to calculate the deferred tax amount each year. This was the calculation for year one. Let's also quickly calculate for year two as well. Let's quickly do the calculations for year two. We start with the carrying amount of accrued expenses for year two. The carrying amount is actually equal to zero because I paid the amount. Therefore, I do not have any amount in my accounting balance sheet. Once the expense is actually paid out, I do not have any more liability outstanding on my balance sheet. Therefore, the carrying amount goes down to zero. For the second year, the tax base is also equal to zero. All right, tax base was zero in year one and in year two. Third step is calculating the temporary difference. All right, calculating the temporary difference, which is going to be equal to carrying amount minus tax base, which is also going to be equal to 0. Where the temporary difference is positive in case of a liability. In case of a liability, if temporary difference is positive, I told you that it represents the amount that will be allowed as a deduction in future. And where it is negative for a liability, I told you that it represents the amount that will be taxed in future. But over here, temporary difference is neither positive nor negative. So there's no reason for us to classify this further. All right, there's no reason for us to classify this further into deductible or taxable temporary difference. All right, because it's zero, I'm not classifying it as deductible or taxable temporary difference. And I'm moving on to the next step. My deferred tax asset or deferred tax liability will also be equal to 0. All right, the deferred tax asset and deferred tax liability is basically temporary difference multiplied by 30 percentage. Temporary difference is 0, therefore my DTA and DTL is also going to be equal to 0. Now I have the change in DTA. If you think of it, these calculations are being done at the end of year two. So what I'm saying is at the end of year two, I should be having a deferred tax asset equal to 0 in my books of accounts. At the end of year two, my deferred tax asset should actually be equal to 0 in the books of accounts. But I already have a deferred tax asset of 30 rupees in my books of accounts because I recorded a deferred tax asset in year one. I recorded a deferred tax asset in year one of 30 rupees, and that is going to still get carried forward into year two. All right, asset balances get carried forward, right? Because asset is basically a balance sheet item. The balance keeps getting carried forward. Therefore, in my books of accounts, I already have a 30 rupees of deferred tax asset, but it should now come down to 0. I have an asset of 30 rupees. It should now come down to 0, which means that I need to record a reversal of asset. I need to record a reduction in asset or a reversal of asset of 30 rupees. I need to record a reversal or a reduction in asset of 30 rupees. And because it's a reduction in asset, I credit DTA and the debit goes to deferred tax expense. All right, this is basically a reduction in asset, a reduction or a reversal in asset. A reduction in asset means that I need to credit it. All right, it means I need to credit DTA. The debit will go to deferred tax expense. All right, we'll debit deferred tax expense. This was what we actually saw as the journal entry when we calculated above. Before we saw the steps of Ind AS 12, when we saw the journal entries, also the journal entries were the same. It's just that Ind AS 12 gives you a stepwise procedure that we are required to follow in case of every item. All right, we are actually required to do these 5 steps for every item on the balance sheet. We are required to do it for all the assets and for all the liabilities. Just like how we did it for interest receivable and accrued expenses, we are required to do it for all the assets that you see on the balance sheet and all the liabilities that you see on the balance sheet. And we are required to record a DTA or a DTL on every item of asset and liability. Will every item actually result in a DTA DTL? The answer is no. If let us say the carrying amount and tax base are equal, all right, and all the in the two examples that we have seen, we've actually taken cases where carrying amount and tax base were actually different. But it's not necessary that they're always going to be different. If carrying amount and tax base are equal in year one, if let us say both of them are equal in year one, there's no temporary difference. Therefore, there won't be any DTA DTL. All right, so with that, we are actually done with example number 17. Sorry, what was this? Example number 12. We're done with example number 12. Example 12 actually only required us to calculate the tax base. If you notice, the tax base of accrued expenses is nil. All right, this is basically for year one. All right, they're saying that the tax base is actually equal to nil, which is also what we also calculated. We prepared a tax balance sheet to understand what the tax base is, and we also had the same value of tax base equal to 0. All right, so with that, we're done with example number 12. Before we end this lecture, I would actually like to show you a snippet. Now, if you look at this snippet, what it says is for assets, if the carrying amount is greater than tax base, carrying amount greater than tax base for assets means it's a positive value. It's a positive value. All right. If the carrying amount is greater than tax base, the temporary difference is a positive value. A positive value represents that I will have to pay taxes in future. It is the amount on which I need to pay taxes in future. Therefore, it's a taxable temporary difference, and I create a deferred tax liability in my books of accounts. All right, what they're saying is if the carrying amount is greater than tax base, then it's going to be a positive amount, which means that I will actually have to pay taxes on that amount in future, and therefore it's a taxable temporary difference, and hence I will create a deferred tax liability. The same positive amount for liabilities. For liabilities, if it's a positive amount, it is a deductible temporary difference, which is what we had in the example that we just did. All right, where liabilities have a positive temporary difference, it means that this is the amount on which I'm going to receive a deduction in future. This is the amount that will be deductible in future. Therefore, it's a deductible temporary difference. And on that deductible temporary difference, I record a deferred tax asset. I'm recording a deferred tax asset because I'm going to get some benefit in future. Same way, if let us say if the carrying amount is less than tax base, if the carrying amount is less than tax base, my temporary difference is negative. My temporary difference is negative. A negative temporary difference in case of an asset means that I told you that it is the amount that will be allowed as a deduction in future. So therefore, it's a deductible temporary difference on which I recognize a deferred tax asset. And for a negative temporary difference in case of liability represents a taxable temporary difference on which I record a deferred tax liability. You might just be completely messed up with this matrix, and it's going to be impossible or maybe slightly difficult for you to remember as you go ahead what positive means and what negative means for assets and liabilities. All right, but obviously we're going to actually see the logic of how to actually conclude whether it's a taxable temporary difference or a deductible temporary difference, and after that I'm reasonably sure that you would not have to actually mug this up. All right, you would not really have to by heart this up. You will actually be able to understand it logically itself. All right, so that is what I actually wanted to show you at the end.